Netflix has transformed from a simple DVD by mail business into one of the most influential entertainment companies in the world. And today, we are going deep into how the company is performing financially, how its strategy is evolving, and whether Netflix still deserves a spot in a long-term investment portfolio. This analysis is based on the company's most recent financial results from 2025, along with management commentary, long-term trends, and the current competitive landscape. So let's break down the real story behind Netflix. If you think Netflix has already peaked, the numbers may surprise you. The company is now delivering double-digit revenue growth again, expanding margins, scaling its ad-supported business, and generating billions in free cash flow. But at the same time, it is facing rising content costs, global regulatory risks, and fierce competition across streaming and social media. So, the question is Netflix entering its next golden era, or is the platform heading towards slower growth and rising pressure? To answer this, we have to start with the fundamental. In the second quarter of 2025, Netflix generated about $11.08 billion in revenue, which was roughly 16% higher than the year before. Net income came in at about $3.12 billion, translating to earnings of roughly $7.19 per share. Operating margins for the quarter reached more than 34%, which is extremely strong for a media company that invests heavily in content. Netflix also produced around $2.4 billion in operating cash flow in that quarter, with roughly $2.3 billion in free cash flow. Because of this strong performance, management raised its full-year free cash flow guidance to between $8.0 and $8.5 billion. This kind of cash generation allows Netflix to invest aggressively in content while still buying back stock and strengthening its financial position. Most investors do not realize how profitable Netflix has become. For years, the criticism was that Netflix burned cash to buy subscribers. But now, the script has flipped. Netflix is one of the most profitable companies in entertainment. Now let's move forward to the third quarter of 2025. Revenue reached about $11.51 billion, which represents more than 17% year-over-year growth. Net income for the quarter was roughly $2.55 billion, and earnings per share came in at about $5.87. Operating income reached approximately $3.25 billion, though the margin dropped to around 28% due to a $619 million tax charge related to a legal dispute in Brazil. Netflix made it clear that without this one-time issue, its margin would have exceeded expectations. This is important because it shows the core business remains strong. Netflix also produced about $2.66 billion in free cash flow during that quarter. With revenue trending toward $45 billion for the year and margins stabilizing near 29%, Netflix continues to prove that its model scales efficiently as global demand for entertainment grows. Now let's talk about what is driving this growth. First, the ad-supported tier is finally gaining real traction. Netflix has stated that ad revenue more than doubled year over year, and the company is now heavily investing in its own ad technology, including tools that provide advertisers with more targeting, more flexibility, and more premium inventory. Ads create an entirely new high-margin revenue stream that sits on top of the existing subscription model. This is one of the most important long-term growth catalysts for Netflix. Second, Netflix continues raising prices, particularly in major markets like the United States and Europe. Despite the price increases, engagement has remained extremely strong, which suggests Netflix still has pricing power. When consumers willingly accept higher rates, that translates directly into higher revenue per member. Third, the content strategy remains a central pillar. Netflix continues to invest in original series, blockbuster films, and is expanding its presence in live programming, including live events and sports. This is a major shift from its past approach, and it allows Netflix to better compete with traditional broadcasters and even premium cable networks. The company is also experimenting with interactive entertainment and games to increase engagement beyond traditional viewing. Netflix is no longer just a streaming service. It is building an entire entertainment ecosystem that includes shows, movies, games, events, advertisements, and global content tailored for every region. Fourth, global expansion plays a major role. Because Netflix is active in more than 190 countries, changes in foreign exchange can significantly impact revenue. When the US dollar weakens, Netflix's international revenue benefits. This dynamic can meaningfully influence quarterly results, especially since most of Netflix's growth now comes from outside the United States. Finally, Netflix's strong free cash flow allows it to return capital to shareholders. With billions in excess cash, Netflix has increased its stock buybacks, signaling that management believes the shares remain undervalued relative to long-term growth. Now let's shift to the risks. The first major risk is regulatory and tax exposure. The recent legal dispute in Brazil cost Netflix more than $600 million in a single quarter. And although management expects this to be a one-time issue, it shows how vulnerable global businesses can be to regulatory surprises. Similar issues in other countries could pressure margins in the future. The second risk is rising content costs. Netflix must continue spending aggressively to maintain its competitive edge. Big budget productions are extremely expensive, and as more competitors enter the market, bidding wars for major titles can intensify. If spending grows faster than revenue, margins could be squeezed. The third risk is competition. Netflix competes not only with traditional streaming services like Disney+, Amazon Prime Video, and Max, but also with social media platforms like YouTube, TikTok, and Instagram. These platforms are battling for attention, not just subscribers. Every minute viewers spend on short-form video is a minute not spent on Netflix. The fourth risk is macroeconomic pressure. In periods where global consumer spending slows, discretionary services like streaming can see higher churn or slower subscriber growth. While Netflix is somewhat insulated by its global diversification, it is not immune. The fifth risk is execution. The company is expanding into advertisements, live events, and gaming. Each vertical requires near-flawless execution. Any delays, poor product rollouts, or failed initiatives could reduce investor confidence. Now let's put this all together with an investment thesis. In the base case scenario, Netflix continues to grow revenue in the mid-teens annually, supported by higher pricing, stronger ad monetization, and steady global growth. Free cash flow remains robust, and margins stabilize near 30%. This creates a sustainable long-term growth profile for the company. In a bullish scenario, the advertising business becomes a powerhouse, contributing billions in high-margin revenue. Interactive content gains traction, and Netflix's global expansion accelerates. If this happens, Netflix could see its valuation re-rate higher as investors recognize its transition into a diversified media and technology leader. In a bearish scenario, regulatory costs escalate. Content spending rises faster than revenue, competition increases, and subscriber churn becomes a real issue. Margins could compress, forcing Netflix to either slow investment or accept lower profitability. The real question investors must ask is this: do you believe Netflix can evolve into a multi-platform entertainment giant? Or do you believe the best days of streaming are behind us? In conclusion, Netflix is not the same company it was 5 years ago. It is more profitable, more diversified, more global, and more strategically positioned than ever before. But the risks remain significant, especially as the entertainment landscape becomes more competitive and more regulated. For long-term investors, Netflix offers a compelling mix of growth, profitability, and innovation. But success will depend on how well the company can manage rising content costs, navigate international regulations, and scale its new ad-supported business.